Welcome to the Broken Pie Chart Podcast, episode 132. I'm your host, Derek Moore, and this week we're going to get a little bit more behind the numbers on inflation, what it means for the Fed, what this latest jobs number meant with regard to interest rates and the Fed and all that stuff. I mean, look, when you see a lot of this stuff, especially if you're watching, mainstream media, you're just watching NBC Nightly News or getting the headlines. You're really not getting the whole picture. And beyond that, if you want to start to understand this, and if you want to get, be able to sort of be intelligent on what's going on and give both sides, you've got to look behind some of this stuff. We just recently had the jobs data come out on Friday, and it was surprising. I would say this is a big miss. So the estimate was 720,000 for hiring new jobs, and for August, and it was only 235,000. So that's a big miss. And I'll get into the labor participation rate in a little bit because that's something to look at. And what does this mean really for the Fed? Well, the market did go down a little bit, although sometimes bad news is good news with regards to interest rates. And it does give the Federal Reserve, a little bit of ammunition not to raise rates anytime soon. Not like anybody has really said, if you look at the Fed funds futures, not till 23 they're really pricing in any type of increase. But that was definitely a surprise. And at the same time, wage growth has been moving higher. And we know we're going to talk about inflation for a little bit, but look, there's sort of a lot to get into here. So we talked about the jobs number, CPI, by the way, consumer price index is going to be coming out, or at least the August number is going to be released September 14th. That will be a big release. And everyone that you move forward, it starts to be, I wouldn't say it's more meaningful. It's just you've heard them say the base rate problem. Meaning, if you are comparing inflation or CPI in Q2 of 20 when everything was shut down by the government, then of course any number now is going to be a really high percentage. The other thing too is that we've started to see things like prices on rental cars, airfares, those types of things. In the reopening, year over year, those looked like, rental car prices were up like 100% year over year. Of course, because nobody was renting cars. But as you go forward and you start to get further and further past the lockdowns in the U.S. at least, certainly Australia, I think New Zealand, but Australia especially, they're locked down now. The calculation, the numerator-denominator issue will sort of start to work itself out a little bit. So that certainly is going to be a big thing. By the way, in that report, I mentioned this before, I continue to look at the sticky CPI versus the flexible CPI. And the flexible CPI is stuff, I'll just call it stuff, that is more apt to see, more volatility in price changes, where the sticky consumer price index things or stuff, we'll stick with stuff, that has not moved as much. We haven't seen that spike really a lot since the late 70s into the early 80s. So still watching that, and the indication on that one is that while the flexible stuff certainly is surging, it has surged before, it has declined before, but that more steady line of the sticky CPI, it's not moving that much. So that's another thing to look at. I'll link to a prior episode where I went through the sticky versus the flexible CPI. I think it's worth certainly taking a look at. So when we think about going beyond the headlines, I'm going to talk about the labor participation rate in contrast to the unemployment rate. Also, we need to touch on container shipping prices and chip shortages. We need to talk about that. Also, the government transfer payments, which, of course, we had 2 big rounds of stimulus. the ending enhanced unemployment benefits. I think at least for, I think the federal unemployment enhanced benefits are going away. Most of the states are going away with the exception. I think California is doing something else. They're sort of the outlier there. But, and the impact there on the job market and a couple other things. So let's look at unemployment since we just talked about the jobs number. Now, it's worth repeating, although I haven't said it on this podcast, but I've said it before. The unemployment rate is based upon a survey. They take a survey and then I believe they extrapolate it out to get population data, but they call people up. And I think they still just call people. I don't know if they do anything online, but basically it measures the workers or the share of workers in the labor force who do not currently have a job, but are actively looking for work. And so if they call people and they say, you know what, I've been out of work, I haven't even looked in the last 4 weeks, they are not included in the measure. And when I get to the labor participation rate, that's sort of the second thing that is looked at, because that's a good gauge of certainly not only the unemployment rate, but then what percent of the population is working as the labor force shrunk. And so with the latest release, this is through August, the unemployment rate dropped to 5.2%. To give you a little bit of a scale on that, in February of 2020, it was 3.5%. So, and then of course it spiked 14.8% in April of 20, and has started to certainly come down since then. So, although the unemployment rate is down to 5.2%, what has not recovered now, unemployment's not certainly back to its pre-pandemic February low of 3.5%. That's pretty low. I mean, that was decades and decades low unemployment, which unfortunately, you think back, the economy, at least a lot of the measures, there are things below the surface, but a lot of the measures that you saw were really trending in a good direction. We had wage growth, low unemployment. Anyway, that's another discussion altogether. So then you look at the labor participation rate. And, that certainly is not near where it was. Labor participation had hit, I think it was decades high as well, right around, 60, let me look at this one, about 63.5%. Now, it went down to 60.2%, but it's only recovered to 61.7%. So if you could see this on a chart, it has not come back. It has not come back to prior levels, certainly below prior level trend lines, as is the unemployment rate. But one of the things that tells you is that the labor force has the participation rate of the labor of people who could be working is down. And so that's another area where even if the Fed said, the Fed has said, look, we want to have inflation run a little bit hot. They're still calling it transitory or temporary. But at the same time, they want full employment is one of their mandates, or at least they say it's one of their mandates. And so they do have some cover in that until the labor force participation rate gets back up to, the pre-Q2 20 levels, that also does give them a little bit of cover. As we're talking about that's one thing I would say. You want to follow the labor participation rate, the unemployment rate. These are all, certainly good things to look at. I mentioned the ending of the enhanced unemployment, and there's been a lot of debate on this topic because what happens there is, so take away the politics of everything, right? But when you have the government injecting more money like they did essentially private employers are now competing against the government for workers. And so somebody says, well, I can continue to get these benefits, or maybe they'll wait until the benefits are done. And I think that's why you see, job openings are high right now, and a lot of just anecdotally, just talking to some people locally here, they've told me that, right now they need more workers, but they can't necessarily find them. And they've also pointed to some of the enhanced unemployment benefits. But the other thing too is that a lot of this one person I was talking to was saying, look, if I pay a lot more to get workers, I've got to raise prices, and then at the same time, does that hurt my my sales? So it's sort of they're stuck in a little bit of a rut here. But when we think about the unemployment benefits, and then we look at the stimulus and things like that. So there are a couple different measures. You can look at salary plus wages. By the way, all of this is available on the Federal Reserve Bank of St. Louis website. But you can look at salary plus wages, and you can go back and you can see that, okay, in what is this? In 2020, so this would have been, what is that? Let's say the quarter ending, January, February, March of 20. Wages plus salary plus wages was something like 9.6 trillion. Yeah, 9.6 trillion. If I'm doing my math right, the way they work this out, it's in billions. So then you got to add the zeros, right? And at the same period, if you look back and you say, what were, let's see. Actually, I gave you the wrong number. So now I'm looking at, Q1 was 9.6 trillion. And government transfer payments. So this is social programs, unemployment, all that, food stamps, all that stuff was about 2.4 trillion. So that jumped. So what happens is salary plus wages went from 9.6 trillion to 8.9 trillion. And government transfer payments, the social programs, went from 2.4 trillion to 4.7 trillion. So a really big increase. And you could see stimulus 1 came back down, stimulus 2, and it's coming back down. The latest numbers I have through Q1, a little over 10 trillion salary plus wages, but we're still about 3.4 trillion in, I'll call it, government transfer payments. So I bring this up because you sort of see how much government transfer payments increased. And like I mentioned, there is some competition, right, for workers. But this also goes into inflation. And so when you have, the back of the envelope definition of inflation is, too many dollars chasing too few goods. And so I think the different stimuli, is that plural? Yeah, I think it's plural. We'll go with that. The stimuli, or various stimulus payments and increased unemployment, that has put some pressure on prices. I will say that wage growth has increased. So we're seeing wages increase, although on a nominal basis, we're still seeing it below trend line. But nobody can argue that, if you look at the over the last 2 years post, pandemic, wages went up during a recession. That never really happens. And the reason why that happened is because the government transfer payments. So you've got a weird situation right now where wages are up, the pace of hiring has slowed. I think what will be interesting there, just as a side note, is once you see all of the enhanced benefits come off, that's going to be a number to watch as they end. And it might take a little bit of time, right? But September, October, I think the September numbers, but then certainly the October numbers, those will be interesting to see if the job openings come down and if a lot of those folks decide to go to private employers rather than the government. But I also think it's worth mentioning it's still up in the air. There's two bills right now. There's an infrastructure bill, which I think was a little over $500 billion. That has passed the Senate. It has not been taken up for a vote yet in the House. Some in the House are saying, look, we'll only vote on this if we get to the second bill, which is the reconciliation budget bill. So if you're not familiar with reconciliation, usually once a year, this year it'll be twice because the Congress actually didn't pass a budget last year, I do not believe, so they can do it twice this year. Don't quote me on that. Like, do your research. I'm not a parliamentarian expert on this, but I know enough, to talk about it. But this reconciliation bill doesn't need the 60 votes in the Senate, and so that's the one where they're talking. At least the headline number is $3.5 trillion. And it would also couple with tax increases. So that remains to be seen whether there's enough support for that. But keep that in mind, because if you do see another round of stimulus, remember that is a lot of gasoline to put on the fire. So let's talk a little bit too about what's going on behind the headlines. And a lot of the response so far has been for a demand side recession. So just thinking, let me kind of paint the picture for you. You probably, if you ever took an economics course, you remember the supply and demand lines. You made one line for supply, one line for demand. By the way, and it wasn't me who was clever enough to come up with this, but when you draw the demand line, you draw it from the top left down to the right, demand to the dirt, and supply to the sky, meaning you go from the bottom left-hand corner all the way up to the right. And where they meet in the middle is where, that's your equilibrium. And so where demand meets supply, that's the price level that people are, everyone demanding goods, they get what they want, and the supply supplies that, and they agree on a price, right? So that's equilibrium. So what happens is if demand is the culprit, if demand weakens, and so let's say there's a recession and demand weakens, that's considered a demand side recession. And there's a lot of different schools of thought on what to do, but judging from the economists who are advisors or a lot of them, they are Keynesian economists. And their main thing that they do is they say, look, demand weakens, causes recession. Then the government has to come in with a lot of stimulus to stimulate growth. And governments spend money, and they believe it creates jobs, gives money to spend, that type of thing, right? The other side of this, though, is a supply side recession. And so supply side recession is a little bit different. And when you have issues, well, first let me sort of explain what it is, okay? So supply side recession, right? That would be, and I'm not saying, by the way, we're going into recession. I should mention that. But the idea of, again, when there's a demand recession or demand falls, the Keynesian view is to pump money into the economy because the government sort of has to step in for the private sector and believes demand is the problem. If you stimulate the demand, you can get the economy back. On the supply side, though, it's a little bit different. And so we really haven't seen, I shouldn't say we haven't seen it, but certainly the 1970s, You had supply side shocks from oil. That was kind of a good example, I guess. But supply side is where supply is less, and I'll get into some of the reasons when I get into shipping and chips and things like that. But supply sort of shifts, and it what that means is less is available, but at the same time you have rising prices. So I would say that supply side shock then, and I'm not saying this is a shock, but basically what happens is you got lower output, you have lower amounts that are being produced, and you have higher prices. And so there's some talk about this now, and I think I'm coming around to the idea that we have more of a supply problem. And I know some of you might say, well, isn't that obvious, right? Well, it's not entirely obvious, but it just seems that as I get into some of the shipping stuff, that could be what's going on here. And the thing is, if it is a supply side problem, then if you do more stimulus, or if there is rising wages, increased government transfer payments, that sort of does not correct that problem. It exacerbates the problem. And so this kind of leads us into what's going on with the supply chain. I did a whole episode of how container shipping is causing issues on the supply chain and causing increased prices. So I won't rehash all those points here. But I will tell you, if you look at shipping rates for containers from Shanghai to LA, the port of LA, and Shanghai to Rotterdam, those respectively were something like $1,000 or $1,500 to ship a container to either LA or the Netherlands from Shanghai. And recently to LA, I think prices are over $10,000 now, and I think they're approaching $13,000 from Shanghai to Rotterdam. And so think about that. Prices are up 10 to 10x or something like that, right? In a lot of cases. Now, there's some components to this too, because some companies have long-term shipping contracts, and they've already sort of have signed contracts, have arranged pricing and things like that. It's more complicated than to be on the scope of this podcast. But you certainly have not only increased prices to ship, you've got backlogs. I read an article in Bloomberg the other day that recently there were 40 container ships anchored off the port of LA, Los Angeles, just sitting there because there was delays getting into port. And when there's delays, there's also, you've got issues with truckers just sitting there at the port waiting. So a lot of backups. The other thing is with some of the COVID shutdowns. So recently in China, I think it was might mispronounce this, but Rantian port. In China, it's a pretty big port. I think it's responsible for something like 20% of global shipping, or at least 20% out of China. I don't remember which was which. But you shut down this port, and all of a sudden, I think they had 100 ships that were sort of off the coast of China in different places. So there is not only increased prices to ship, but also delays. And so you've got all of these delays in getting goods and services. All right. We think about chips. I think I read in the Wall Street Journal that some of the car manufacturers are actually going to pare back the manufacturing output because they're waiting for these microchips. That these new cars, they have chips in them, and according to Bloomberg, I think it was over 20 weeks now, the chip shortage. And so this is the gap between ordering a chip and delivery has grown to 20 weeks. 20 weeks, that's 5 months. So if you need this chip, that's there's sort of a wait for that. Anecdotally, I was listening to a podcast and the host explained a good illustration of how this has led, the chip shortage has led to not only a shortage of goods, but also maybe an increase in what people have to pay. This host went into they needed a new, I think it was a washer or a dryer. I'll call it a dryer. And I think the appliances were the color white, right? Goes into the thing and the guy says, yeah, no problem. We'll probably have, it's probably like 5-6 weeks to get a new dryer in. Or you can do this one here that I have that is silver and it's like $100 more. And obviously somebody not wanting to wait 6 weeks for a dryer, pay the extra $100. And so all of this sort of goes into the supply side of things. And I think what is interesting here is, so then the natural thing is, and we're nowhere near, I don't think anybody's, well, no, there are some people, but again, I don't know what's going to happen. Let me be clear on that. I want to help you look at this data and start to think about it critically. And in no way, shape, or form am I saying we're going to have stagflation. But stagflation is when you have rising prices, inflation, and you have shrinking or lowering GDP, gross domestic product. So the economy is shrinking at the same time prices are rising. And that is sort of the least beneficial environment to be in, because a lot of the moves that the Fed normally would do, like hiking interest rates, you hike interest rates to curb inflation at the same time you have a slowing economy. Again, I'm not saying that we're going to have a stagflation, recession. I'm not calling recession. I don't know when the next recession is happening, but these are all things to sort of think about. So, as we want to have a good idea of, so what do we look for? All right. So if I were you and you want to be tracking this stuff, I want to be looking at not only the jobs numbers, I want to be looking at the unemployment rates. I want to find a source. So freightwaves.com is a source that I found that puts out some shipping container cost. I think that's an interesting side thing, off to the side to look at. If you follow the Wall Street Journal or Bloomberg, they've been covering the chip thing. I would look at this. I would see if those wait times start to come down. And the GDP numbers, Atlanta Fed GDP nowcast, which, by the way, recently that one shows. Now, a nowcast, by the way, is like right now, based upon all the things that we have and all the data, what are we estimating on an annualized basis GDP to be? Their September 2nd update was positive 3.7%. But I can tell you at one point it was over 6%. It doesn't mean it can't go back up. This is a nowcast. It's going to be volatile. And you're not going to have all the final things for, we're not going to have a preview of Q3 GDP until sometime in October. And that's the first one. Then it gets revised the second time. Then you get the final number, the third release. So it's going to be a while before you get that. But I would watch the Atlanta GDP. By the way, Atlanta Fed also has a wage growth tracker that you can take a look at. You should be looking at the labor participation rate. And I bring all this stuff up because the Fed just had their meeting, which they titled an uneven recovery. They were supposed to meet in Jackson Hole, Wyoming. Of course, they did it virtual, and Chairman Powell gave a speech. But they sort of told you some of the things they're looking at. And one of the graphs they had was the labor participation rate. Another graph they had, and this is important to bring up, is the increase in let's say, spending on durable goods. Durable goods is, washing machines versus services. Services are experiential things. So services is nowhere near their pre-Q2 2020 trend line. But durable goods, which had not moved much for many, many years, at least on a year-over-year inflation basis, that has, that some of that stuff is higher. again, uneven is their theme. And so you can look at durable goods prices. You can look at services sector spending. You can look at retail sales. So plenty of stuff for you to be looking at. Manufacturing is another one. Manufacturing certainly is something that you want to take a look at. So anyway, I wanted to do an episode where I kind of, a little bit of how I've been looking at this, trying to give both sides of it. And, all of this, and remember, if you're investing, if you're putting money to work, all of this stuff though, if you have hedges in place, hedges or buffers or other things that give material protection on the downside, like you don't have to try and pick market direction from all this stuff. Because if you're hedged, you have protection in place. If it goes down, you have the ability to sort of rebuy at lower prices. If it goes up, you participate in a good amount of the upside. So, I don't want you to, if you're sort of losing sleep at night, that's a different conversation. I'm happy to have that with you and try and help you out. But these are the things that I look at on the economic side. And I think you're going to see more talk in the coming weeks or months about, wait a second, maybe this was a supply side issue. And, the stimulus, and if they do more stimulus, that would be inflationary. And I think the other thing you got to watch is once all these enhanced unemployment benefits come off the table, September, and you may not see it in September, right? I mean, somebody who's like, okay, now, I've gotten this, I'm going to go, because now they're making it's their opportunity cost. So like I could go work here, or I could take some of these benefits. And by the way, it's not to say that there are folks that are on benefits who no choice of their own wound up in a situation that they have that, right? But I think based upon the number of openings and unfilled openings and just ancillary conversations that I've had with people in business, of them not being able to find workers, I think it will just be interesting to watch. And you might not see it until November when they release the October numbers, to see on that participation rate, to see on the openings, to see on the unemployment rate, all of these things, right? So anyway, I'll put some links into the show notes. Coming up next week, I think it's next week. Yeah, next week, we should have a really good guest, and we're actually going to stick on inflation, and we're going to talk about TIPS bonds, so Treasury inflation protected bonds, and kind of go through pros and cons. Are they the best thing to own if you're expecting inflation? And just understand, really getting a deep dive, because I think it's a really misunderstood asset, and there's a lot of moving parts, and some of them aren't what you seem, some of them are, but I think it will be a good episode. So I think we're going to record that in, let me see. That's probably, we're going to record that in a week or so that will be up. And we'll have some other guests coming up as well on the show. As always, if you want to reach me, I'll put my email in the show notes. Happy to talk to anybody. And a lot of these episodes, just like this one, are audience suggestions. So if you have a guest that you think you want me to talk to, go ahead and shoot me an email. derek.moore@zegafinancial.com is probably the best one to reach me at. And I'll put that in the show notes. And yeah, let me know your questions. Let me know episode titles and topics that you want me to do. And if you have a guest suggestion, if you want to be a guest, go ahead and, if you're a good fit for the program, I'll put you on. So, all right, folks, we will talk to you all next week. Take care.